From Wall Street to Main Street to help small business owners have the same capital as corporate America and give them the same resources as a larger company. We cover business funding, business credit, scaling, business consulting, and much more. Check out the website at shieldadvisorygroup.com. Welcome to the show, The Liquid Lunch Project.
Hey everybody, welcome back to another episode of the Liquid Lunch Project. I am Matthew Army, and alongside my partner, the Professor Luigi Rosabianca. What's on tap today, Lou?
Oh, tonight we're going to give our audience a curveball. Matt, you and I oftentimes we're so busy with work and our families and just surviving, right? It's trying to stay fit, get a good night's sleep, eat right. We often neglect some important attributes of life, all right? Today on the podcast, we have a very special individual. The man has more initials after his name than we have an alphabet. So he's highly, highly credible. Matt, we live in a very special place right now. The world is blowing up, and you and I live in a very pristine, white reality. We love our families. We live in safe neighborhoods, but there's turmoil in Southeast Asia. There's turmoil in the Middle East. Our politicians in Washington for the last 50 years have gone mad. Crime is at all-time highs. It's really difficult to keep your finger on the pulse on what on earth is going on. And then enter stage right, Amir Goren, who likes to keep his finger on the pulse by translating these macro trends into micro investment advice. So Amir, welcome to the podcast. You are so well received. Can you please try to kind of give us the Reader's Digest version on what's going on planet Earth?
Thank you, Luigi, and thanks for the warm welcome. Sure, I've been tracking what's going on both in Ukraine and in the Middle East. And it does look like things have been blowing up a little bit over the last couple of years. And so I'm originally from Israel, so I'm kind of in the weeds of what is going on there with the war and everything. And I think we're at the end of the ceasefire that was brokered about a week ago or so. So we're approaching the end of that, and I expect a continuation of the fighting. The big question in my mind is whether this is going to lead to a regional war, because at the end of the day, the Hamas there is a proxy for the Iranian regime. And in the north of Israel, there is another proxy, which is Hezbollah. And if the Iranians decide to give a real fight, they would throw Hezbollah into the mix as well. And so that's a big question, because if that happens, then that could lead to a regional war. The Houthis in Yemen have been already kind of in the mix, shooting missiles at Israel, taking over ships. And so if the Iranians themselves decide to block the Straits of Hormuz, which is a key choke point in the export of oil from the Persian Gulf, then that could spike the price of oil significantly and probably trigger a quicker recession than people expect. And so that's a quick question. I know that the U.S. is doing everything that it can to prevent the deterioration of this very local war into a regional war by putting a very credible threat with carrier groups and so on. But we'll see how it goes. I think that if Hezbollah sees that Hamas is about to be eradicated, they might jump in and decide that they need to intervene.
Yeah. So, I mean, with your background, and we have to let everybody know that you're a hedge fund manager, right? So you're paying close attention to what's going on in the geopolitical environment all over the world. And this is very important to your investment strategy. With that being said, we all know where there's crisis, there's also opportunity to be had.
Right.
Now, if we had this podcast 6 weeks ago, I would have said the markets we're going down, we're hitting recession, we're not coming back. But since that point, 6 weeks ago, the market's rallied, and it's rallied pretty hard. Now, we all thought, and I thought personally, oil was going to spike, and it didn't, right?
Right.
But I think today we have OPEC meeting, right? And they want to cut their production levels. However, the problem there is the U.S. is actually putting out about 13 million barrels a day right now, right? If the production, I could see if a full-on war goes out, how it spikes. But what do you see if OPEC cuts production? Does it even matter? Or will oil spike a couple bucks a barrel? What are you thinking?
I think that for now they're struggling to keep the price of oil afloat. It's been kind of on a free fall after the stabilization of the conflict, or the intervention of the U.S. to keep it a limited conflict. The expectations of an oil spike kind of went away, and the price went down. The thing is, it could change very quickly based on the geopolitical situation. I think that from the other portion, the other fear is that the U.S. already released all of its strategic petroleum reserves. So if a problem occurs, then there's no cushion, right? So if something happens and the Iranians do close the straits, then it would be a very violent price shock in the oil market. So that's one direction it could go. Regarding the recession and the markets going down and so on, I think you're right. I've been surprised at how resilient the economy has been, despite the monetary tightening and the higher price of oil and so on and so forth. I think there's kind of a tug of war going on between the Treasury and the Fed. The Fed is trying to tighten. The Treasury is trying to boost the economy with fiscal deficits and trying to keep the economy going into the election year. Obviously, they don't want to see the economy crash into a recession in an election year.
Yeah, I think, in my personal opinion, I think some games are being played with some numbers here, because, I mean, if we go out 10 years from now, the GDP is going to be 118% of the debt that we have. And if we go into a recession now, I don't see how we're digging our way out of it. But I mean, you're a lot smarter than me. What are your thoughts on that?
Well, I think that we are slowing down. So, despite what I said about resiliency, I think there is a slowdown, and I think that the market is ignoring it for now. So it's not baked into the asset prices yet. Mm-hmm. So far, we are in kind of a perfect trinity assumption of a soft landing, which includes three ingredients. One is disinflation. The second is continuation of growth. And the third is lower interest rates. And I just don't see all of these three things happening together. And so I think at some point the market would have to acknowledge that at least one of these things is not happening. Either inflation is happening, and also the lower oil prices are happening because of lower demand and the slowdown and a beginning of whether it's a soft landing or some kind of a recessionary trend. And that's not baked into the markets at all. So if the markets begin to acknowledge a slower growth rate and lower profits and so on, and then that would have to create a correction in asset prices. I think what we saw with the asset prices began with treasuries. So we had a rebound in treasuries because of the lower inflation. So there was a relief rally in U.S. treasuries because suddenly inflation went down, and it looks like everything is happy. That's kind of the first leg of the rally in treasuries. The question is what is going to happen if it continues. So treasuries can, it can be a relief rally, but can also be a recession rally. So if it continues up, what I think might happen is that it could reverse carry trade. Many people did a trade of buying high yield bonds while shorting US treasuries. So basically, you could structure a carry trade where you can make the difference in the interest between kind of a risky bond and a very safe bond. So you basically sell the safe bond and buy a risky bond, and make the gap in the interest with leverage. And so if that trade becomes unwound because of a rally in treasuries, it could kind of feed itself. And if it is unwound, then people would have to sell high yield bonds and buy treasuries to close the trade. And so that could create a continuation of the relief rally in treasuries and spike both basically push down the yield on treasuries and push up the yield on high yield. And that could be, I think that's kind of the main chart to look at right now. I posted it on my Substack. It's basically the trade of long high yield short treasuries. And if that reverses course and breaks down, that means that it's probably a sign that we are heading into a recession and asset prices are about to correct.
So in terms so the audience can understand, we're talking about maybe a 10-year bond, or are we looking at the 30-year bond?
Yeah, either way. So I use in the chart, I use TLT, which is 20 years.
Okay.
It's the ETF for the 20-year treasuries. And you can just see that being long, high yield, short TLT was a great trade for the last 2 years. Since the COVID recession, it's been going higher and higher and higher. And now it made a slight correction because of the drop in inflation and the relief rally in treasuries. But what I'm saying is that it could develop into something more violent downward if it creates an unwinding of this carry trade.
Gotcha.
And so if it continues to rally, if the short side continues to rally, then people will have to cover, and that would push this.
It'll cause, down. It'll cause people will have to cover and start buying the bonds to cover their position, which will cause the yield on the bonds to go higher.
Right? Yeah, and that's kind of the canary in the coal mine, kind of in my mind, which would say if the flows continue into treasuries, then it's kind of a sign for a risk-off mentality where people start to sell their stocks and buy safer assets like treasuries in preparation for more difficult times. And another interesting chart that I saw the other day was that the correlation between treasuries and stocks tends to change when the inflation is lower. So in normal times, when the inflation is low, stocks and bonds kind of are used as a shock absorber. So when stocks go up, bonds go down, and vice versa. So usually it's a good practice to have some money in both types of assets. But in recent years, when inflation was high, they actually went up and down together, and that created a lot of havoc for funds. But when inflation goes down again, they begin to behave more like shock absorbers again, and begin to be negatively correlated. And that's kind of the situation that we are in right now. So that's another reason for money flows to go into treasuries and out of the stocks, if indeed the outlook is for a slowdown.
Amir, for our audience out there that has a fleet of trucks that they have to fill fuel tanks for, and those of us that need to travel to visit clients, let's take a step back and focus on the fuel conversation again. Let's look at this hemisphere. Should the American small business owner be too concerned with OPEC when in this hemisphere we have wonderful reserves in Guyana, in Venezuela, in Canadian shale? Or is there a real concern because we need to buy fuel like the rich uncle that needs to give enough gifts to all his nieces and nephews, even the ones he doesn't like?
Right. The problem is that it's an international market. So it's not that we're going to be missing quantities of fuel. It's not that there's going to be a shortage in principle, but for the producers, if they can sell overseas for more money, they will do that. And so what happens is that higher prices overseas also push higher the prices in the American continents. And so that's, despite the fact that there's no shortage of oil on this hemisphere, the price does change with the global events. And that's the risk, basically.
Okay, so let's take our globe and spin it like the Harlem Globetrotters, and let's end up somewhere in Southeast Asia. So over the last decade or so, it took China about 100 years, but they finally gobbled up Hong Kong without muddying a single British spat, right? It was very peaceful. What would have been a tumultuous war a couple of hundred years ago, they played the long game and just took over a wonderful city-state. What's happening right now in the South China Sea and Taiwan, and how does that affect us as American consumers?
Well, I think the remaining island, or the main island that they are planning to take, is Taiwan. And that has very big ramifications in terms of the technology industry, because that's where most of the semiconductors are being produced. And so I think that the US is not going to let that go, at least not at this point. So I think they're trying to kick the can down the road, move as much semiconductor manufacturing to the US, and that's the CHIPS Act. And once that is over, once it's no longer a serious risk, because a lot of the defense mechanisms or defense products, missiles and so on, rely on these semiconductors. And so once the US has relocated the semiconductor industry, or enough of it, to the US, I think then they're going to let Taiwan go. And basically, Taiwan will become another part of China. And I think that if China tries to go for Taiwan too early, that's going to be a war. That's going to be a world war. And I think that one of the reasons why the US is trying to be very aggressive or have deterrence in the Iran situation is that it wants to kind of rebuild credibility, because it lost some credibility with Afghanistan. And it's not clear, and also with Ukraine, because it's not clear if it's really willing to, follow up on threats, right? It starts wars for not very good reasons, and then it doesn't have the stamina to follow through and to finish it. So I think that's something that they realized, and they're trying to show more follow through, both against Hamas and against Iran, to kind of put their foot down and say, no, we're not going to stand for this, and we're going to do what's needed. And if they manage to rebuild their credibility and deterrence, maybe they can prevent China from doing anything stupid, and wait and realize that it can get Taiwan if it just waits, 10 years until it's no longer a strategic interest for the US.
Listen, make no doubt about it. The administration that we have in the US right now is a weak administration. Enough said. Right now, I feel like we're rattling the saber, not because we care, because it's a re-election year coming up. And the problem is, if our current president is re-elected, there's no stopping Taiwan. There is no stopping Russia from going where they want. There's no stopping Hezbollah and Hamas, because they know they have Joe Biden for 4 more years. That is my opinion on it. So something needs to be done. But the biggest problem, and what most people need to understand, is the reason Taiwan is important is we say semiconductors. Basically, these are chips that go into your cars. They go into every electronic device that we have. That's going to drive up inflation here, just like it did in COVID when we had no supply. But chips is only one part of that, right? We all talk about chips because we need them in the U.S. Military complex, industrial complex, right? But they also control our supply chain on medication, right? Nobody's talking about that. So in my opinion, we're going to keep pandering to China until we can get free of everything that they need. I think they're the biggest supplier to the US for blood pressure medication, right? And nobody really talks about that, or that aspect of it.
It's mostly the chemicals that go into the medication production. So they are kind of the upstream supplier of the chemistry of the materials that go into medicine production.
Not even just medicine. It's also all these EV cars, all the materials you need to go into EV cars. China went around 15 years ago and bought up all these mines all over the world.
Right. And that's really, this move is really, you can't really understand why the US decided to go all in on giving China this gift of control of the auto industry when it was the inventor or the original producer of autos, to just give it away to China when they control everything, all the materials for batteries, all the advanced battery production companies are there. Everything is there.
Well, listen, they just gave it to them more because, Biden just sold himself for more votes with the auto workers union. But what most people don't realize is with the auto workers union, we're going to give you more money, right? That means the cost of cars are going to go up. The cost of car goes up right now. If we're in a recessionary environment, nobody's buying those cars, right? And you'll get paid for a while, but you're putting your long-term livelihood in jeopardy because your pensions will be slashed. You know why? Because it takes less of a workforce for EV cars, right? So everything's going to be replaced with EVs. And while Tesla's slashing their prices on cars, GM and Ford have to raise them to pay the auto workers. So somebody really needs to explain in common sense to what people are voting for when they vote for it, not just read the headlines.
It's even worse than what you're saying, because what happened was that these companies, GM, Ford, and so on, they saw the success of Tesla and the drop in the price of batteries, because more quantity meant that it was more efficient to produce the batteries and so on. And they assumed that this is going to go on forever. And they decided, everybody at the same time, to jump with 2 legs into this EV market. But when you spike the demand for the battery materials, obviously the prices are going to jump, right? There's very limited supply of lithium and graphite and all of these metals, all of these raw materials that you need for that. So what happened was that the price of batteries spiked again. And for some reason, they didn't take it into consideration. And so they built this huge capacity for producing these batteries. And those were, the capacity was really based on previous generation of batteries. So I think it's already going to be obsolete very quickly. All this investment is going to be obsolete very quickly because it's old technology. And they just stopped designing gasoline cars. They said, by 2030, we're going to be all electric. They started to transition each model to an EV, and nobody wants to buy those because the charging is not ready. People are complaining that they go to a charging station, most of the chargers are broken, and because of that, there's a huge line. People are running out of juice. It's a horrible experience, and people that bought EVs are selling them back, and the prices are crashing. The used EVs.
Amir, let's pivot the conversation a little bit to demographics. So let's set the stage a little bit. Our buddy Vladimir just made a patriotic plea to the women of Russia to have 7 to 8 children. He literally said, please have 7 to 8 children because we are having a demographic nightmare.
Yeah.
The industrial nations of Western Europe have population decline. And then you have a country like India that reproduces the population of Germany every year.
Right.
What implications does that have? I'm going to go back for us humble Americans. I mean, there's like a population shift, and forget about the water and the food issues. But what does this demographic shift do to macroeconomic environments?
One question. Start selling into the Indian markets. That's what you do. Establish yourself right now and start selling in India.
Yeah. Well, there are two parts for growth, economic growth. One is the population growth, and the other is the efficiency, the technology, basically technological growth and the accumulation of more and more capital. And so when you lose the population growth, obviously the economy is not going to grow as a whole. And in some places, in most places in the world, in China, in Europe, all the places that are going to face a cliff in the population are going to experience shrinkage of their economies. And that has very dire ramifications for the debt, because what happens is that if you already have a debt that is already large, even before you shrink the economy, then what happens is that if you cut the economy by 20%, suddenly the ratio of debt to GDP is going to spike, and your hope of ever repaying the debt becomes more and more difficult. So I think that's the biggest ramification, is that. The second part is really whether this is going to also affect the GDP per capita growth, right? So you can shrink as a whole, as an economy, but per capita, maybe you can keep the same per capita GDP, and maybe even grow the per capita GDP. But I think, people have been scaring about AI and how it's going to take everybody's jobs and so on. I think it's actually the big hope in that sense, because if it can keep the productivity high and allow people to be more productive by giving them more productivity tools, that would be the only miracle that could save these economies from shrinking so severely.
Yeah, but we're having that same issue here in the U.S., right? We have the baby boomer generation who's retiring or just leaving the workforce. Now we have a deficit that's going to be by 2030, $46 trillion, right?
Right.
How are we paying that back? If you can't tax all these people because they're not working anymore or there's really no tax, where are we making this money back, right? How does AI, you can't tax unless we have an AI tax. We're going to have an AI tax. What do you think about that? That might be something.
Yeah, I don't think that AI is going to replace people, but what it can do is give you, each one of us, the ability to produce more. So if by some miracle, and I can't tell you exactly how that is going to happen, right? But if by some miracle it's going to allow each of us to produce twice as much as we produce today, then that's the miracle that I'm talking about. That would be the, you see, so
totally,
that's the miracle that we need. But repaying the debt, it's very hard to see how we are repaying the debt.
It's going to be interesting, but yeah, no, I totally agree with AI. We're already using it in our businesses that we have here. I mean, basically, if you're a one person or you're a solo entrepreneur, AI will allow you to be in more places than once and get the menial tasks that you don't need to do, and you can spend your time on more valuable tasks. Done. It's amazing.
Right.
You know?
Yeah.
Hey guys, let's look at this simple little device, right? Matt, what has this device done for our respective businesses over the last 20 years? Like, we used to have a room of receptionists and typists and data entry and assistants and secretaries. There was so much data that needed to be manipulated, and all that can be delegated for a device that's $1,000, right? Good old iPhone. So if AI can 10x, 100x that, I mean, who knows? That could be the cure for our GDP concerns.
Listen, I think everybody's in hope and pray mode on that one, because that's where they're turning to say how we're going to get out of this mess.
Yeah, absolutely. It's not going to be easy. It's already, as it is, it's not going to be easy to pay back the debt. But if you add on it the issue of population shrinkage, it becomes even more difficult, right? If you put these two together.
Well, that's why we need immigration, right? We need healthy immigration reform, and increase the H-1Bs, increase the skilled practitioners, and I think that's a healthy balance. But Amir, Matt and I do not want to paint the bleak picture of global economics, because there's always been bad news. There's always been strife in the former Yugoslavia. There was problems in South Africa, and we evolve, right? The Irish hated the Brits, right? We evolve, and it basically comes down to the haves and the have-nots, right? So the more prosperity, the more we all get along. So Amir, give us the rosy silver lining, right, around these dark little geographic clouds that we've seen. Give us your short-term prognosis on what's going to happen in the microeconomic environment.
Yeah, I think that the next year is going to be a slow economic year, possibly a recession. And I think that there are going to be opportunities for investment for those who kind of kept their powder dry. There are going to be opportunities to buy things on the cheap. And I think that if indeed there's going to be a recession next year, then the Treasury is going to step in, because it's an election year. They're going to step in, with everything. And they're going to spend like crazy. I mean, they're already spending like crazy, but they're going to spend double crazy to try to get the economy out of a recession quickly. And so they're going to give away checks again and so on. So if that happens, then 2025 is going to be a boost, and everything will come back. Assets, at least, are going to come back very violently. So there's going to be, it's very possible that there's going to be an opportunity to pick up things on the cheap during 2024 and benefit from that during 2025.
I mean, I feel like we could pick your brain for days, but just a few more little anecdotes, and then we'll let you move on.
But one second. I'm going to take the flip side of that equation. I think I'm a little bit more bullish than Amir because I think the US is going to prop up the market as long as it can. But I think somewhere in the fourth quarter, we're going to start to see a decline. Okay. And the reason I say this is everybody I speak to has been waiting for this recession and waiting for this recession to come and been putting dry powder away. Right. And one thing I did learn on Wall Street is when everybody's waiting for something to happen, it doesn't happen.
Right.
And I'm almost in the camp where maybe we're coming out of that recession. Maybe we were in that recession already, right?
Yeah.
We are seeing food prices starting to fall a little bit. It's still very tolling on the average US consumer right now.
Right.
But we did have an awesome Cyber Monday and Black Friday. So people are still spending out there. Now, look, there's still a lot of high credit card debt. People still they're not tapping the equity in their homes just yet. I have a feeling we're going to see a rate cut around the second quarter of next year. It's going to prop up I don't think it's going to be sustainable, but I think you put money to work now.
Yeah.
Actually, I've already started, right? But then we'll also have to deal with the commercial real estate fallout and see how they handle that, right? But I think from now till October, November next year, I think the economy is going to do pretty well. And I don't know if it's going to be real, right? I'm not saying that.
Yeah.
I trade what I see, not what I think, because whatever I think, 9 times out of 10, I'm wrong.
Right.
So that's what all signs are pointing to me. Sorry about that, Will. I just wanted to take the flip side of that one.
No, I appreciate that. I was actually going to ask Amir a much more simple question. I wanted to hear his take on gold.
On gold, usually it goes up after the recession. So when there's monetary easing after the recession, right now it's picking up as part of the easing in inflation. I'm not clear what the thinking is, but usually the big spike in gold is happening when you have monetary easing. Maybe that's the thing that people are expecting, a reduction in rates soon. I just don't see a reduction in rates without a slowdown. So I think Waller came out last week or so, or maybe earlier this week, and said that they already see significant signs of slowdown in the economy. And that's why they may be able to reduce rates.
But let's talk about that for 1 second, right? And they're looking at data. They're looking at trailing data, not future moving data.
Right. That's true.
Right. Yeah. So that's a big problem when they come out and speak because they're not dealing in real time data. Like the first one to call this hyperinflationary environment that we went into is Jack Dorsey because he ran Square, right? Block now. And the reason he was able to see what was going on in the trending environment was because they had access to real time data from everybody swiping their credit cards and seeing where all the transactions went. So I think that's a problem with all this data that we see. It's all lagging indicators. Right. So I think the reason the market is higher is because people were predicting that a couple months ago. Right. And now the Fed's actually coming out and saying.
Yeah. Full disclosure, I do have a position in gold miners, but I always take, it's always hedged. So I will make money whether it goes up and down. So I don't have a strong conviction right now that it's going to be a sustainable rally right now in gold. If what I'm saying is going to happen with the recession and everything, then at the bottom of the recession, that's going to be the point. Because if they do come in with guns blazing, the Treasury, and try to save it before the elections, it's going to shoot, very high, very quickly.
Going to the moon. We're going to the moon.
Yes.
Amir, thank you so much for being here, man. I really enjoyed this podcast. It was great speaking with you, getting your views on everything. Can you just tell the audience where they can find you, how they can reach you on Substack? By the way, guys, he puts out an amazing Substack and gives all his insights in there. So Amir, why don't you tell the audience where they can get you on the socials?
Sounds good. So I'm at Economic Defense, both at Twitter and on Substack. Publish regularly, so I'll be happy to see you there.
Amir, thank you so much. One question before I let you run. One industry to go long in right now. I know what you're going to say.
Well, I'm already, it's a little bit late. Uranium has been doing very well, and I'm long that. It's going to do a pullback probably right now, but it's going to be an opportunity for people to join the party.
Amir, thank you so much. Everybody, that's a wrap at the Liquid Lunch Project. We'll see you on the next episode.
Thank you for listening to the show. And make sure you subscribe, leave a review, and share it with a friend. We'll see you on the next episode of the Liquid Lunch Project.